debt crises, inflation trends, and 5-year fiscal safeguards in key nations. An in-depth analysis of fiscal pressures in France, Finland, Austria, and Belgium. In the grand theater of global finance, credit ratings aren't just abstract scores. They're the spotlights that illuminate a nation's economic health or cast long shadows of doubt. As we navigate the choppy waters of 2025, 4 European heavyweights, France, Finland, Austria, and Belgium, have felt the sting of downgrades from major agencies like Fitch, Moody's, and DBRS. These moves aren't isolated blips. They're symptoms of broader strains: ballooning public debts, stubborn inflation pockets, anemic growth, and the relentless pressure to balance books under EU fiscal rules. Picture this: a continent still reeling from post-pandemic spending sprees, energy shocks from geopolitical tensions, and now, the creeping specter of trade frictions with major partners. The downgrades, clustered in the first half of 2025, have jacked up borrowing costs and rattled investor confidence. But amid the gloom, governments are scrambling with multi-year fiscal shields. Think austerity tweaks, EU recovery funds, and structural reforms to stave off deeper crises. In this exclusive analysis, we'll dissect each country's debt mountain, inflation pulse, growth trajectory, and protective playbook for the next 5 years. Drawing on fresh data from the IMF, European Commission, and rating agencies, we'll humanize the numbers. These aren't just stats. They're the stories of families facing higher taxes, businesses eyeing cautious expansions, and policymakers walking a tightrope. France, the Eurozone's debt behemoth, faces a reckoning. France, the Euro area's second-largest economy, has been the poster child for 2025's downgrade drama. In December 2024, Moody's sliced its rating to Aa3, citing unchecked deficits. The blows kept coming. Fitch dropped France to A+ in September 2025, while DBRS followed suit to AA just a week later. The rationale? A fiscal deficit ballooning to 5.6% of GDP in 2025, far outpacing the Eurozone median of 2.7%, and public debt that's a staggering €3, 416 billion as of Q2 2025, equivalent to about 116% of GDP. This debt pileup isn't new. It's the legacy of expansive welfare spending, green transitions, and crisis responses. Absolute terms paint a vivid picture. That's enough euros to fund the entire French healthcare system for over a decade, or build high-speed rail lines across the continent twice over. Yet, as ordinary Parisians grapple with grocery bills, inflation has mercifully cooled to 0.9% in August 2025, down from peaks above 6% in 2022, thanks to ECB rate cuts and softer energy prices. Still, it's a double-edged sword. Low inflation eases household pain, but signals weak demand in a sluggish economy. Growth? Don't hold your breath. The OECD pegs 2025 GDP expansion at a meager 0.6%, dragged by trade headwinds and domestic uncertainty. Factories in the industrial north hum at half capacity, while tourism in the south sputters amid global slowdowns. Looking ahead, France's 5-year shield is a €50 billion consolidation package unveiled in July 2025, aiming to trim the deficit to 4.6% in 2026 and a EU-compliant 3% by 2029. Key pillars include pension tweaks, green investment tax breaks, and leveraging €40 billion from the EU's Next Generation EU Fund for digital and eco-upgrades. But skeptics whisper. Political gridlock in the National Assembly could derail it, echoing the yellow vest protests of yore. If executed, though, it could stabilize debt at 115 to 118% of GDP through 2030, buying time for a rebound to 1.2% annual growth by 2028. Finland, Nordic prudence meets unexpected headwinds. Up north, Finland's downgrade by Fitch to BA in July 2025 shattered its aura of fiscal rectitude. Once a beacon of balanced budgets, the country now stares down a debt-to-GDP ratio climbing to 86.3% in 2025, from 82.1% the prior year, translating to roughly €240 billion in absolute debt, given a GDP hovering around €280 billion. This surge stems from defense hikes amid Russia tensions, aging population costs, and a post-COVID slump in exports like timber and tech. Inflation at 1.7% for 2025 is tame by Eurozone standards, allowing the ECB's dovish pivot to boost consumer spending in Helsinki's cafes and Tampere's startups. Yet growth remains elusive. Forecasts pencil in 1.0% for 2025, a tentative thaw from recessionary chills fueled by construction rebounds and EU green grants. For everyday Finns, think families in Oulu bundling up for long winters. This means modest wage gains but persistent housing affordability woes. The 5-year horizon? Finland's midterm policy review in May 2025 outlines a €10 billion adjustment, slashing deficits from 4.4% in 2024 to 3.6% by 2027 via spending caps on welfare and targeted R&D boosts. Protections include ring-fencing education, a Finnish hallmark, and tapping €3 billion from EU cohesion funds for northern infrastructure. By 2030, debt could plateau at 85% of GDP if growth accelerates to 1.7% annually per the Finance Ministry. It's a pragmatic Nordic blueprint, not flashy, but built to weather storms. Austria, stagnation in the shadow of recession. Austria's summer of discontent peaked in June 2025 when Fitch downgraded it to AA, spotlighting a deficit yawned to 4.4% of GDP and debt at €412.6 billion by Q1 to 83% of a €500 billion economy. Vienna's opulent streets mask deeper woes. 2 years of contraction, minus 1.1% in 2024, have left manufacturing in Styria idle and tourism in Salzburg vulnerable to airline woes. Inflation ticks at a worrisome 4.1% in August 2025, driven by service costs and energy residuals, eroding the savings of middle-class Viennese. Growth? A dismal 0.2% for the year, per the OENB, as consumer confidence lags. It's the story of baristas in Innsbruck, wondering if tips will cover rising rents. Over 5 years, Austria's fiscal armor includes a 2026 budget targeting 4.2% deficits through subsidy trims and €5 billion in EU-funded rail modernizations. Moody's noted the negative outlook in August, but Scope affirms AA+ with consolidation hopes. Debt may crest at 86% by 2028, but reforms in labor markets could unlock 1.2% growth by then per IMF projections. It's a delicate dance. Cut too deep, and recession lingers. Ease up, and markets punish. Belgium. Political paralysis amplifies debt dilemmas. Belgium's downgrade to A+ by Fitch in June 2025 underscores a familiar tale. Chronic coalitions breed fiscal inertia. Public debt stands at €536 billion federally. April 2025. Pushing total to over €600 billion, or 106.6% of GDP. Brussels. Bureaucratic heartbeats amid Walloon-Flemish divides, with deficits forecasted at 5.5% for 2025. Inflation at 2.12% in September eases from 3.6% earlier, but food and housing spikes hit low-income households hard. Growth inches to 0.8%, buoyed by exports but hampered by uncertainty. For Antwerp traders, it's cautious optimism amid port delays. The 5-year plan? Aiming for 3% deficits by 2028 via tax hikes on high earners and €20 billion EU green bonds, though IMF warns of 123% debt by 2030 without bolder moves. Protections hinge on stability pacts and pension reforms, potentially capping debt rise if politics align. Broader implications. A continent at the crossroads. These downgrades aren't just national headaches, they're Eurozone tremors. Borrowing costs have spiked 20 to 30 basis points per ECB data, squeezing budgets when growth averages under 1%. Yet silver linings emerge. Converging ratings foster solidarity and EU fiscal rules, deficits under 3%, debt below 60%, enforce discipline. Over 5 years, expect €200 billion in collective adjustments, blending cuts with investments in AI and renewables. For citizens, it's real. Higher VAT in Belgium, delayed retirements in France. But resilience shines. Europe's social safety nets and innovation edge, think Finland's tech hubs, offer buffers. As 2025 fades, the question lingers. Will these nations turn downgrades into upgrades or deepen the divide?